So I know it has been a treacherous journey, especially for investors that are invested in Chinese big tech for some time now. So regardless of all the different price actions and how Pelosi is visiting Taiwan, or how the entire property bubble is going to collapse on itself, or even how the Chinese GDP is going to shrink in 2022 because of their mismanagement of the pandemic policy, I just wanted to go back to day zero, where I revisit my entire thought process into understanding why we were interested and why we are currently invested in Chinese equities, specifically Chinese big tech. And this is just a simple presentation that I put together specifically on the names of Alibaba and Tencent. And I would definitely love to trade notes with all you viewers out there. So remember to help smash the like button as well, and feel free to leave in the comment section what I left out or what you think I could have delivered better. Also, this video is sponsored by Weibo. Every single new signups can get up to 100 USD worth of Google shares. I'll leave the link and instructions down below. Essentially, you just need to deposit a minimum sum of 2,000 Singapore dollars and execute a total of 6 trades in the first 30 days. That's an 8% ROI in 1 month. Definitely better than Alibaba. Jokes aside, Weibo also allows for investing into fractional shares. And I don't know why this is not a common feature for other brokerage platforms. So they pride themselves in zero commission trading as well. Don't let this 8% ROI deal get away. Link in the description. Now, getting back to the video. So let's begin. The sorry state of Chinese tech giants today. So before we begin diving deeper into Alibaba and Tencent specifically, I've recently came across this very interesting infographic from 金石数据. So I've named the source here, don't say that I plagiarized them. So just some perspective and to really ground you into understanding valuations of markets today. So 2 years ago, on April 27th, 2020, right around when the world was experiencing serious lockdowns and everybody was trying to grapple or wrap their minds around the entire pandemic issue, Apple actually had a valuation of around $1.2 trillion. So if you were to compare it to their Chinese big tech counterparts, I think it's of comparable footing. Because if you were to look at all the different big techs of China, Alibaba was around a $550 billion market cap, Tencent was $500 billion, and just 5 of the big tech of China of the yesteryears was around $1.2 trillion market cap. However, in today's context, 2 years later, this was dated a while back. On the April of 25th, 2022, Apple was valued around 2.2 times or 2.3 times more at around $2.6 trillion market cap. While you add up the entire Chinese internet big tech sector, you have your Tencent, Alibaba, Meituan, JD, NetEase, Pinduoduo, Xiaomi, Baidu, NIO, etc. etc. All these add up, there is still a surplus of $1.4 trillion compared to Apple's $2.6 trillion market cap today. And this just shows you the stark contrast in terms of valuations. And even though you can call them, oh, they're all big techs, one is a big tech of US, one is the big tech of China, there is a huge disparity in terms of how the market is valuing them. And whether is this an opportunity or a crisis, I'll leave it up to you to decide. But that said, of course, naysayers are going to say, oh, US big tech company has an international audience and they have an outreach of international consumers, etc. But for all this Chinese internet tech sector, they only focus primarily on the Chinese market. Sure, I believe Alibaba only supply to the Chinese consumers. But that said, I think a huge part of deriving Amazon's goods is probably from China as well. And similarly for Tencent, I think running the biggest gaming portfolio in the world, by the way, I'm sure they only pander to the Chinese population. Who am I to make the judgment? I think on top of that, if I were to go a step further, because many of all these Chinese big tech companies are listed on the Hong Kong exchange, let's purely look at it from the China's lens and China's perspective, where I named 10 of the biggest Chinese companies. I don't care whether they are tech or not. So you have Tencent first on the list, and then you have Moutai, which is a liquor company, and then back to Alibaba. ICBC is a bank. CATL is more towards a battery technology. Then China Construction Bank is a bank, Agricultural Bank, Meituan is a tech company again. So adding all of them up, the top 10 Chinese most prestigious company, or the most quote-unquote valuable company, they're still not worth the valuation of Apple today. So that's just some food for thought. So of course, many people are going to bounce back, hey, investing in China versus investing in the US, it's of vastly different magnitude. And I totally agree, and I can totally concede to that fact. So that's why I think in the center of the discussion today is the man in the middle. So he is allegedly the downfall of all these valuations of these different Chinese companies. So we will definitely explore in this short presentation today. So I just wanted to answer some macro questions first. So I've actually answered this question in greater details and greater nuances in one of my previous video. So if you haven't catch that, do check it out. I think it's called "There is no point investing in China." So just to give you some very rough thoughts, this person proclaims, "Personally, I just think no point investing in China given the current socio-political climate. When you invest in a US company that has a supply chain and or sales in China, you are already exposed to China. When you invest in a Chinese company, you are exposed not just to China, but also its political nonsense and coercion and possible fake reporting." Rather than looking at it from an anecdotal lens where somebody is commenting of it from his own experience, if you were to just look at it purely from a numbers perspective, if you were to just look at the last decade or so, since 2014, albeit in 2015 and 2016, there was a slowdown in terms of interest in Chinese equities or bonds or credits, etc. because of certain restructuring in the economy. But from the graph, clearly you can see that there is a heightened interest and there's a huge velocity of value moving into Chinese onshore equities and also Chinese onshore assets. And more importantly, if you were to observe the monthly flows, inflows and outflows on onshore stocks, most of the time there is a net inflow into Chinese onshore stocks. That said, I think just to keep to your attention, based on March of 2022, there is a huge outflow of funds, probably because of the potential sanctioning risk, because that was also when Russia invaded Ukraine. So don't take my word for it. Listen to what Howard Marks have to say on China.
One of my heroes was Peter Bernstein, the investment philosopher who died around 2009, I believe. And he wrote a memo, which is one of the greatest things I ever read, called Can we reduce risk? Can risk be reduced to a number? And one of the things in there is he said, there's a range. We don't know where the answer is going to fall within the range. Sometimes we don't know the extent of the range. China the range is enormous, because we're dealing with cosmic questions. And by the way, we think we can do economic analysis or financial analysis. These are not economic or financial questions. These are political, ideological, social questions. But it's an important question because China is the second biggest economy in the world. And I have friends who can tell me the date on which it will become the biggest economy in the world. I've always thought you should have money invested in China. And, one of the things I've seen over my years in this business is something comes up, whether it be index funds or emerging markets or something like that. And people say, oh, we got that covered. I got 2% in that. If it's important, 2% is not enough. It won't move the needle. Now, people are happy with 2% because at least if it then goes on to quadruple, they can say, I participated. They don't have to kick themselves. But it's not enough. So if China's going to become the world's biggest economy, and if things work out in a positive way in the long run, 2% in China is not enough, in my opinion. And as you say, we've had investments in Chinese equities. We've been long-term investors in Chinese NPLs, and we're investors in Chinese debts. How do you dope it out? Not easy. On the one hand, you do have the economic strength, size, and growth potential. On the other hand, you have the question of how will China behave towards its citizens, its businesses, and towards the rest of the world. And so in the last 6 months or so, we've seen people say China is not investable. That's the word, uninvestable. Now, my ears perk up when I hear that, because if nothing else, it introduces the possibility that China is cheap. By definition, nothing that people describe as uninvestable can be borne aloft on the winds of adoration.
So I think just to circle back to the discussion on whether I think there is a point in investing in China, my baseline is I think there is a point. So rather than just focusing on having exposure to China via US companies, so many of your popular stocks like Tesla, Apple, Starbucks, Amazon, they do have exposure to Chinese, the Chinese way of doing things, because at the end of the day, a part of their sales or part of their supply chain is exposed to China. I think a key part of the argument is that, hey, you tend to forget that China also has a huge swath of talent pool. They have many people that graduated universities. They have a huge deal of software engineers, of great talents, great business people as well. So by investing solely into US companies, you don't get access to these sort of people. And I think a very real example that's happening in real time in the market today is that look at Facebook or look at Meta platforms. They are facing huge amount of headwinds or competitive pressures from TikTok. And where's TikTok from? TikTok's parent company is ByteDance, and ByteDance is from China. And they only took probably 3-4 years to get to where it is today. And who do you think is running the algorithm? Who started the algorithm in the first place? In the US, Silicon Valley, or was it from China? And who took them by a storm? So those are the few guiding questions to think about. Having exposure to China via US companies versus investing into Chinese companies, having particular access that you can't get via US companies. So that's the first part. On the second part about political maneuvering and coercion, etc. And I do admit to that fact, and the entire political maneuvering in China today is essentially a black box. So you don't know what you're talking about, I don't know what I'm talking about. So I'll stay clear of that. At the end of the day, I still focus more on the business fundamentals, how they deliver value, and how they're going to accrue value to shareholders at the end of the day. On the last part about possible fake reporting, of course, I'm not going to denounce that fact. I'm not going to denounce that possibility. But like I always mention, China don't have a monopoly over fraud or over fake reporting. The US, even Europe, has their own fair share. So that's why I tend to avoid small Chinese companies, and I only focus on large big cap stocks. And if you haven't realized already, Alibaba is at least a 20-year-old company, same as Tencent. So that's just some of my rough thoughts. So zooming specifically into Alibaba and Tencent, you can see that Alibaba, that was listed back in 2014, essentially traded sideways for a good 7 years. Tencent, on the other hand, has traded sideways for the last 5 years, but it has listed very long time ago, back in 2004 in the Hong Kong exchange, and it has essentially returned around 38,000% for early time investors. But truth be told, if you were to ask me, if you can turn back time, go back into 2004, I wouldn't have invested in Tencent as well, because back then, Tencent was also a very small company trying to make its way or fight its way up to the top. So investing back then would definitely reap you a great deal of rewards, but always think of it from a risk-reward perspective. And also, for many of the skeptics out there saying that investing in China won't give you returns, think about it again. I don't think 38,000% is not returns. Maybe if you can outdo it, then kudos to you. I'll give you 2 thumbs up. So now, the natural question would be, what happened to Alibaba and Tencent? Why did they book in zero shareholder value over the last 5 to 7 years? Long story short, I've screenshotted a huge deal of different headlines. But allegedly, the stopping of Ant Group's IPO was the first cut for this downfall of all these different tech conglomerates. So on top of that, you have fines on Alibaba, you have fines on Meituan, you have fines regarding antitrust, you have fines regarding disclosure violations, you have crackdowns on gaming, you have crackdowns on live streaming, you have crackdowns on tutoring, you ban kids from playing online video games, and most importantly, this idea of common prosperity was a very important buzzword back in 2021. So rather than just looking at headlines alone, I think it's better to understand it from a holistic perspective and to really understand the different details and nuances behind these different Chinese regulations. So I really like this tweet from Lilian back in July of 2021. So she said that China innovate, then regulate. Europe regulate, then not innovate. Then the US innovate, then not regulate. Maybe if I can put in my own color, I would say that for the US, they innovate, then try to regulate, but tend to fail. So for a seasoned and experienced investor, I know you guys have sat through a time where China was also tightening its regulatory control over the economy. But back then, it was not in the tech sector. Instead, it was on the shadow banking space. So China was also tightening some sort of their regulatory policy control. So as you can see, China's regulatory cycle actually models some sort of a market cycle, where there is a bull market and then a bear market. Similarly, as China adopts the framework of innovate then regulate, they allow for all these different market participants and stakeholders to innovate first and then start tightening wherever they feel like there is a need to tighten, to essentially align people back to the policy or the major direction of the CCP. So as you can see that in the 2018 episode, based on Goldman Sachs assessment, based on a Z-score, so they triangulated many data points to kind of simplify it. And in 2018, it's evident that there's a tightening policy stance in China. And now, currently, in 2021, stretching into 2022, you can see that our current episode we are in an unprecedented regulatory tightening cycle. So now, moving specifically into Alibaba and Tencent, you can see that I essentially pulled out their key financial metrics and performance. Later in the next slide will be about Tencent. Based on 2015's figure, Alibaba did a revenue of around 11.4 billion USD. And based on last 12-month figure, as of December 31st, 2021, they essentially 10x their revenue. So gross profit similarly, they didn't 10x, but at least this is a 6 to 7x. Although I do understand the core argument of Alibaba's fundamentals eroding, where you can see that, hey, their gross profit margin from 68% eroding all the way to 37%, there is a method to their madness. So I'm going to explain a little bit more in greater details in the later part of this presentation. EBITDA similarly from 4 billion over to 20 billion, that's a 5x. Net income from 3.6 billion to nearly 10 billion in a span of around 6 years. So is this bad performance per se? I don't know. I think you be the judge. So similarly for Tencent, for the last 5 years, they traded flat, so shareholders didn't manage to accrue any form of value or interest, other than dividends, of course, where they gave out JD as an interim special dividend. But you can see that based on 2015 figures, total revenue was around 120 billion Hong Kong dollars. And based on last 12-month figure, this is at least a 4 to 5x. I'm not going to belabor the point, but I guess most of you know where I'm going with this. So looking into Alibaba's business model and to really understand its ecosystem, I think many people like to compare Alibaba with Amazon. However, there are slight distinct differences between the two business models. But that said, let's just compare Amazon and Alibaba to really understand the scale of Alibaba. Because many international investors out there tend to have the impression that, oh, all these US big tech companies are the big bad boys. They're going to dominate the world and they have such a huge global footprint. So sure, let's play into that impression and let's compare Alibaba versus Amazon. So comparing Amazon and Alibaba, Amazon's GMV in 2021 was around $600 billion USD, while Alibaba's GMV in 2021 stretching into Q1 of 2022, that's around 1.2 trillion USD. So that's at least a 2x in terms of the volume of goods that they are transporting in their individual platforms. And you like to think that, oh, Amazon is the big bad guy trying to dominate e-commerce. Maybe think again. I think more importantly, just zooming into the number of users that Alibaba has, because people tend to think that, oh, Alibaba is a $250 billion market cap company. Their operations or their scale are probably not as big. So just based on March of 2022, they recorded around 1.3 billion annual active consumer. And based on a quarter-on-quarter metric, based on a year-on-year metric, there is always a net addition of people interested to tap into the Alibaba's ecosystem. So that's that. In terms of GMV growth, similarly, I think as long as the Chinese economy continue growing, the GMV will probably stay in line as people tend to spend more money. So specifically zooming into Alibaba's ecosystem, they essentially dominate the entire value chain. Many people look into Alibaba, they know their two flagship offerings, which is Tmall and Taobao. And these two alone transported a volume of around $1.2 trillion USD worth of gross merchandise value. So that's the scale. So Alibaba really started off from humble beginnings where Jack Ma and his 17 other close associates started this e-commerce business and trying to educate the Chinese population, the Chinese government and its consumers about what the internet is. And even though it started off with humble beginnings of just trying to be an internet e-commerce platform, over time, they started adding on additional verticals to the business itself. So for those of you who understand the golden triangle metric, where Jack Ma essentially started, but if you want to penetrate into the e-commerce business, not only you need the e-commerce platform, you need a robust enough logistics infrastructure network, and on top of that, you need a secure enough payment network in order for people to trust the platform and to pay a good amount of money for the goods. That's why Cainiao was being born, and then Ant Group was also being born, essentially to supplement this entire infrastructure for Alibaba's business model. So on top of that, the business model of Alibaba is to earn commission or take rate from merchants, and also to earn advertising revenue. So Alibaba was then born. So as time went by, learning from its US counterpart, which is Amazon. So people like to say Alibaba is the Amazon of China, even though I beg to differ. So Amazon's current business really focus a lot on the AWS, which is their cloud vertical. And Alibaba has followed suit as well, so which is why Alibaba Cloud is currently also a very huge talking point for many potential or existing Alibaba investors as well. So just to fall back onto Alibaba's market share, even though naysayers are going to say that, oh, Alibaba is going to lose to all its competitors, JD, Pinduoduo, TikTok, Douyin, etc. So as of 2021, Alibaba still has a very strong foothold in terms of its e-commerce retail market share, sitting at 47%. Sure, competition is huge. They're going to feel the heat. If it's a lucrative industry, everybody's going to try to take market share. I'll be more concerned if there is no competitors at all. But that said, Alibaba is not a new kid in the block. They've been in the business for at least 20 years now. So they're critically aware of their Achilles heel, and they're also innovating at an extreme speed, which comes in Taobao deals, Tao Cai Cai, etc. for the answer to competition. So looking into the financials breakdown, China's core commerce alone, including China commerce and international commerce, still makes up a bulk of their revenue, which is around 76%. And most of their business units are still growing at a relatively healthy clip. You can see that this is based on the year ended March 31st. So this looks at the year-on-year comparison, comparing on an entire year, not on a quarter-quarter basis. So looking at a year-on-year comparison, most, if not all of its business units, excluding digital media and the innovation initiatives, are all still growing at least between 18% to 25%. When, keep in mind the context of China, where people are saying that the property collapse started in 2020, the China's economy is going to collapse on itself, with the perpetual lockdowns in the early part of 2022 as well. So these are all accounted for, and Alibaba still managed to grow top line revenue growth by 19% year on year. So I don't know what's good performance to you, but I think growing in the clips between 18 to 25% seems rather healthy, at least for now. So of course, moving into the current financial year, estimates and consensus are all reduced to a large extent, but we shall see what kind of numbers Alibaba is going to deliver in the upcoming 2 or 3 years. But I'd just like to say, economic modes don't come and go in one day or one quarter. It takes time for things to play out. And if the company you're invested in really do have an inherent advantage, it shows in the financials, it shows in the balance sheet. So that's that. So on top of that, I think Alibaba is also currently in the very heavy reinvestment period right now, where they reinvest heavily. There is a huge amount of capex for their cloud, for their new initiatives and new platforms like Taobao Live and Taocaicai. But based on the latest earnings call, I think management is still very focused in terms of optimizing the cost structure. And you can see that a lot of the innovation arm like Taobao Live and Taocaicai, they have been cutting a lot of fat and they've been pulling back a lot of their costs. So I think moving forward, the management team will be more cognizant in terms of burning money, because we are essentially not in a very pretty times and it's not a bed of roses. So now, if you were to compare Alibaba with Amazon, Alibaba's mission is quite simple. They want to make it easy to do business everywhere. So you can understand that from the genesis of Alibaba's existence, they always like to be asset-light. They want to be the platform. They just want to be the facilitator of enabling all these different small businesses in China today. So there is a huge focus in terms of 3P sales, and 3P just means third party. So on the flip side, Amazon is more focused in terms of delivering superior customer experience. That's why they spend so much capex in terms of building their own infrastructure and owning the entire value chain. So they are much more focused on 1P sales, which is first party sales. And they themselves take the inventory and they sell direct to consumers. So there are pros and cons to both business models. And I'm not here to make the moral judgment which is better, but you just need to understand the nuances between them. However, I think a clear trend that we can see is in the earlier years, Alibaba's margin was in the north of 70%, while Amazon's margin was 25% because of the clear distinct differences in a business model. And Alibaba actually made their revenue mostly from advertising or charging a commission for facilitating the transactions. But in recent years, however, I think both companies' margins are essentially converging towards each other to the mid-30s to 40% range. And the main reason is basically just Alibaba reinvesting into many of the different innovation initiatives, penetrating into groceries, exploring different business models, and also the cloud arm. Because clearly, the cloud vertical of the business is not able to produce 70% margins. Let's not kid ourselves. Amazon, on the other hand, by exploring cloud, will have a much higher margin compared to first-party sales. So by looking at both Alibaba and Amazon, they are both expanding their economic mode, their outreach, and further integrating different business verticals back into their core business. So that's the explanation of why both companies' margins are converging to each other. So I think for existing or even potential Alibaba investors, you guys are probably only interested in two business verticals of Alibaba, which is namely Ali Cloud and Ant Group. So just diving into Ali Cloud, we can see that Ali Cloud recently just turned EBITDA profitable. That's nothing to be excited about because many of us are just interested in Alibaba gaining more cloud market share. But evidently, based on the last few quarters' results, there is a significant slowdown. So as of now, just looking at the facts, Alibaba still has a very strong foothold in terms of market share of the entire cloud infrastructure spending. So they hold around 37%. And many of its major competitors are not your random tech companies. They are all your big conglomerates, all trying to fight a piece of a pie. So like Tencent, Baidu, Huawei. So they all have deep pockets. So at least in the cloud infrastructure space in China alone, it's going to be an extremely competitive space. But I think the biggest promise for many investors is that the China cloud market is still under-penetrated. You can see that based on Alibaba's own assessment of the cloud market, there is still a severe under-penetration in many of the other sectors excluding the internet sector. So including finance, telecom, energy, healthcare. Moving into the decade, it's going to be a cloud and AI world. So who better poised to take advantage of this macro trend? I'll leave it up to you to decide. However, I think a huge caveat that I have to give for potential investors that are not invested yet is it's true that I think the year-on-year growth and based on the earnings quarter results, you can see that there's a huge amount of headwind in the broader Chinese economy today. And many other adjacent industries and a lot of all these different companies are also being a lot more prudent and a lot more careful in terms of this cloud adoption and trying to going into AI, going into tech, etc. So you can see that this essentially impact the top line and bottom line for many of all these tech companies as well. So Tencent and Baidu included. Now, moving on to Alipay, I would just like to provide more color and to provide more perspective in terms of understanding the scale and understanding how big the operations of Alipay is. So a lot of people like to compare it to its international counterparts. So comparing PayPal, Visa, Master. So all these are international conglomerates and they are global brands that facilitate transactions in the whole world, maybe excluding China and probably Russia as well because of the recent tensions between Russia and Ukraine. So PayPal's TPV, which is total payments volume, is around $0.94 trillion USD in 2020 June. Master is around 6.3 trillion, Visa is around 8.8 trillion. And if you were to compare to Alipay, where Alipay has a very strong foothold in China alone, I think in the other parts of Southeast Asia, they kind of do have publicity and they do have exposure as well, but the footprint is not as huge. If you were to add PayPal, Master and Visa together in terms of their total payments volume, it doesn't even come up to what Alipay did. And if you were to look at WeChat Pay, WeChat also did around 12 trillion. It just provides you with some awakening and perspective into understanding how big the Chinese market is and how the world just dwarfed in comparison. So at the start, Alipay really had a very innocent mission, which is to just provide a very secure payment network where consumers and merchants can trust this central entity. But that said, I think over time, rather than just helping facilitate transactions, you can see that based on Ant Group's prospectus, 40% of its business is currently in credit tech. And the payments business, which was its initial mission, only stands 36%. And I can understand why there is this shift because at the end of the day, you can understand this kind of fintech platforms very similar to all these traditional banks. Banks earn money from these huge margins that they collect from lending out easy credit. So you can see that in terms of the credit tech arm of Ant Group today, there is these two specific arms, which is Huapay and Jiepay. So Huapay means just spend and Jiepay just means just borrow. Essentially, they're just trying to extend credit to the normal Chinese citizens, and in return, they're going to get a spread or interest based on the expenditure and based on the credit they're lending out. Simply put, without getting into too much details, based on the technological prowess and the ability for Ant to tap into many of the data points that a huge swaths of all these Chinese citizens has on their platforms, they managed to come up with a very interesting business model where banks and citizens alike do not have a choice but to go back to Alibaba. So personally, I think the crackdown on Ant Group was long due. However, I think in terms of delivering the crackdown and how the regulators and the government behave, could have been done better, not going to lie as well. So with that in mind, I hope I managed to provide some color, especially for potential or existing Alibaba shareholders. And don't be too obsessed with the price action of the company and focus just solely on the business model and why it's a superior business. So leave in the comment section down below if you want a part 2 where I dive deeper into Tencent's business model. And as you can see, I've already prepared the slides. I just didn't want this video to drag on and on and on. So there might be a part 2 depending on the comment section and whether is there even demand for it or not. With that, I'll see you in the next video, but more importantly, I will see you on the moon. Goodbye!